The US-China relationship has always been a complex dance, a delicate balance of power and influence that has shaped global politics for decades. It's a dance of cooperation and competition, where both nations have sought to outmaneuver each other while maintaining a semblance of partnership. Recently, however, the music has changed, signaling a shift in the dynamics of this intricate relationship. The US and China are now locked in a bitter trade war, a conflict that has far-reaching implications for the global economy. Tit-for-tat tariffs have become the norm. The stakes are high, with each side imposing increasingly severe economic measures. This is about more than just trade. It's a battle for technological supremacy, market dominance, and geopolitical influence. It's about global dominance in the 21st century, where the rules of engagement are constantly evolving. The latest round of this economic conflict was triggered by the US, with the Trump administration taking a hardline stance. The Trump administration imposed tariffs on a wide range of Chinese goods, citing unfair trade practices and intellectual property theft. These tariffs, they argued, were necessary to protect American jobs and intellectual property, aiming to level the playing field. China, however, viewed this as a direct assault on its economic interests. The world watched nervously, aware of the potential fallout. Everyone knew that China would retaliate. The question was not if, but when and how severe the response would be. The question was how and when. The anticipation built as the world waited for China's next move. The answer came swiftly and decisively. China announced retaliatory tariffs of its own, targeting key American exports. China announced retaliatory tariffs of its own, targeting key American exports such as soybeans, automobiles, and technology products. The trade war had entered a dangerous new phase with no clear end in sight. The world braced for the economic turbulence ahead. China's response was swift and decisive. In a matter of days, they formulated a comprehensive strategy to counteract the tariffs imposed by the United States. This wasn't just a knee-jerk reaction. It was a calculated move designed to send a strong message to the world. They slapped a hefty 34% tariff on a range of US goods, from agricultural products to manufactured items. This move was aimed at hitting the American economy where it hurt the most. This was a clear signal. China would not be bullied. The Chinese government made public announcements, emphasizing their stance and rallying national support. The streets buzzed with a sense of unity and determination. The impact on American businesses was immediate. Companies reliant on the Chinese market felt the pinch. Factories faced closures, retail stores struggled with empty shelves, and business owners were left grappling with uncertainty. The stock market, a barometer of economic confidence, reacted with fear. Traders on the floor of the New York Stock Exchange were visibly stressed, and the atmosphere was tense. The Dow Jones Industrial Average, a key index of American stocks, tumbled. Investors watched in dismay as the numbers plummeted, signaling a loss of confidence in the market. It entered what is known as a correction, a drop of more than 10% from its recent high. This correction was a wake-up call for many, highlighting the fragility of the economic situation. The tech-heavy Nasdaq fared even worse, plunging into bear market territory. This was particularly concerning for the tech industry, which had been a strong driver of economic growth. This indicated a loss of 20% or more. The term bear market sent shivers down the spines of investors, as it signified prolonged economic downturn and uncertainty. The message was clear. This trade war was bad for business. Uncertainty gripped the markets. Investors were spooked, and the ripple effects were felt across various sectors. The trade war was having a real impact, and not just on Wall Street. Main Street felt the strain as well. Small business owners discussed finances with worry, and the sight of empty storefronts and abandoned factories became all too common. The trade war sent shockwaves through the global economy, causing widespread uncertainty and instability. Financial markets around the world reacted with volatility as investors scrambled to make sense of the rapidly changing landscape. Other countries watched with a mixture of trepidation and frustration. Governments and businesses alike were left to navigate the unpredictable waters of international trade, as tariffs and counter-tariffs were imposed with alarming frequency. They were, after all, caught in the crossfire. The intricate web of global supply chains meant that disruptions in one part of the world could have far-reaching consequences, affecting industries and economies thousands of miles away. Canada, heavily reliant on trade with both the US and China, felt the pressure acutely. The nation's economy, which had enjoyed relative stability, was now facing an uncertain future. The Canadian economy, particularly its manufacturing sector, faced job losses and rising unemployment. Factories that once bustled with activity were now eerily quiet, and workers found themselves in search of new opportunities. Prime Minister Trudeau called for calm, but expressed deep concern over the escalating trade tensions. He emphasized the need for a diplomatic resolution and urged all parties to come to the negotiating table. He vowed to protect Canadian interests, promising to take whatever measures necessary to safeguard the nation's economy and the livelihoods of its citizens. Across the Pacific, Japan felt the heat as well. The island nation, known for its export-driven economy, was particularly vulnerable to the disruptions caused by the trade war. The Japanese economy, heavily reliant on exports, was vulnerable to disruptions in global trade. Industries ranging from automotive to electronics were hit hard, as supply chains were disrupted and demand fluctuated. The Prime Minister called the U.S. tariffs a national crisis. He highlighted the potential long-term damage to Japan's economic stability and called for immediate action to mitigate the impact. He warned of dire consequences for the Japanese economy if the trade war continued. The uncertainty weighed heavily on businesses and consumers alike as they braced for what the future might hold. The European Union, long a champion of free trade, found itself in a difficult position. The EU has its own trade disputes with China. However, it also views the US tariffs as harmful and unjustified. French President Emmanuel Macron emerged as a vocal critic of the Trump administration's trade policies. He called for a united European response to the crisis. Macron went a step further. He urged European firms to freeze all new investments in the United States. This was a bold move. It highlighted the growing rift between the US and its European allies. It also signaled a potential shift in the global balance of power. The EU, it seemed, was ready to chart its own course. Section 5. The Consumer Pinch. The trade war wasn't just an abstraction, it was beginning to hit consumers where it hurts, their wallets. The tariffs, essentially taxes on imported goods, pushed up prices for businesses. These businesses, in turn, passed on at least some of those increased costs to consumers. Everyday goods, from clothing to electronics, became more expensive. A report warned that the price of a high-end iPhone could skyrocket to $2,300 if Apple fully absorbed the cost of the tariffs. This would make it inaccessible to many. The trade war was no longer just a battle between governments. It was directly impacting the lives of ordinary citizens. Section 6. The Spectre of Recession. As the trade war intensified, economists warned of a growing risk of a global recession. J.P. Morgan, a leading global financial services firm, raised the probability of a recession to a staggering 60%. The International Monetary Fund, also known as the IMF, sounded the alarm. It warned that the trade war was undermining global growth and creating uncertainty. The IMF urged countries to step back from the brink and resolve their differences through dialogue and cooperation. However, their pleas seemed to fall on deaf ears. The United States and China appeared locked in a stalemate, each side unwilling to back down. Section 7. The Dragon's Rise. Amid the chaos and uncertainty of the trade war, China sensed an opportunity. The country had been steadily expanding its global influence, particularly through its ambitious Belt and Road Initiative, or BRI. The BRI, a massive infrastructure development project, aims to connect China to Asia, Africa, and Europe through a network of roads, railways, ports, and pipelines. The Trump administration's decision to freeze funding for USAID, the U.S. Agency for International Development, created a vacuum that China was all too eager to fill. With the United States retreating from its traditional role as a global leader, China saw a chance to step into the breach. Section 8. A World Divided. The trade war marked a turning point in the global order. It exposed the growing rift between the United States and its traditional allies. It also highlighted the rise of China as a global power. The world was no longer dominated by a single superpower. A new multipolar world was emerging, one in which power was more diffuse. This new world order presented both opportunities and challenges. On the one hand, it offered the potential for greater cooperation and collaboration. On the other hand, it also carried the risk of increased competition and conflict. Section 9. The Future of Global Trade. The future of global trade remained uncertain. The United States and China had reached a truce, but the underlying tensions remained. The trade war had left scars. It had shaken confidence in the global trading system. It had also accelerated the trend towards deglobalization. The era of unfettered globalization was over. The world was moving towards a new era of managed trade, one in which governments played a more active role in shaping trade flows. This new era would be characterized by both cooperation and competition.